Thanks for tuning in to this week's Signature FD investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, to kick things off, let's first take a look here at market returns. We had a pretty good bounce on Friday, but last week in aggregate did see another week of corrective market action. The benchmark S&P 500 index was down about 2.3%, and now year to date is down about 3.9%. However, a bright spot's been international markets, which have continued to hold up better despite this corrective action in the domestic market. And bonds have provided useful diversification as well thus far here in 2025. Now, market sentiment is pretty washed out right now, and some sort of rally in the weeks ahead wouldn't be a surprise to us. Here's a look at a survey from the American Association of Individual Investors. In the past 3 weeks here, the percentage of bearish votes regarding the direction of stock prices in the next 6 months, it's been standing around 60%. That's historically consistent with what you typically see in a major bear market, not a market that's down less than 4% for the year. So investor sentiment has certainly gotten washed out very quickly. Now, the poor market sentiment is being matched by weakening consumer and small business sentiment. We got an update on each of those last week, and both fell more than expected. So here's a chart showing the economy in blue in the top and consumer sentiment in black in the middle clip. This rapid drop in consumer sentiment is consistent with very weak economic activity. So this is definitely a development that we want to keep an eye on. We also got updates on inflation last week, and those surprised in potentially a good way. Consumer inflation was up 0.2% in February, and producer price inflation was flat. But the caveat is that February inflation data doesn't measure much tariff impact yet. But it does show us that excluding tariffs, underlying inflation pressures are easing. What's more of a problem is that the population's expectation for inflation has been starting to move higher. So, in the top clip of this chart in blue, it shows actual realized inflation. And in orange, it shows survey participants' expectation for inflation in the next 5 years. And as you can see, there's a pop higher to 3.9% last month. Now, the interplay between tariffs and inflation expectations is important. The degree to which companies can pass through tariffs matters greatly for profitability. So does the wage pressure that could come through if consumers expect a higher inflation regime. So, here in this chart in the top clip, we're showing the median profit margin among US companies, and we can see that it's near an all time high. The median company grew earnings over 8% last year, which is quite healthy. Analysts expect even stronger growth in 2025, but that could be challenged if consumers begin to save more owing to their economic concerns, and if tariffs cannot be fully passed on to the consumer. As such, we think that fundamentally there's more risk this year than in the prior two. Now, as such, it makes sense to be very balanced and diversified in portfolios. We've recently downgraded stocks from overweight to neutral. And we're emphasizing diversification within stocks and diversification within bonds. Consumer and business sentiment is being driven by policy uncertainty, and that's a risk to the economic and earnings backdrop. Another risk is that trade uncertainty could negatively impact profit margins as this year goes on. But the data does not yet look recessionary to us. So there is an upside case to be made in the months ahead if some of this uncertainty begins to clear up. As always, thanks for joining us this week. And we have a Fed meeting here in the week ahead. So please join us next week for our update on that and have a great week ahead.